Imagine a company at the absolute peak of its power. It has a reputation built on decades of engineering excellence, a brand synonymous with reliability, and a bold strategy to become the world's #1 automaker. To achieve this, they promise the impossible: a vehicle that is powerful, fuel efficient, and environmentally pristine. They call it clean diesel. But beneath the hood, quite literally, lies a secret. A piece of code, a defeat device, designed to cheat the very system meant to ensure quality and safety. I am speaking, of course, about the Volkswagen Dieselgate scandal. Now, you might think of this as a story about fraud, or perhaps a failure of ethics, and you would be right. But viewed through the lens of strategic management, it is something even more fundamental. It is a catastrophic failure at the point of production. It is what happens when the relentless pursuit of market dominance collides with the intricate, often costly reality of quality management. Today, we are going to look under the hood of the business itself. We are going to explore how organizations define, measure, and strategize quality. We will move beyond the marketing slogans to understand the cold, hard calculus of quality costing and ask ourselves, is there really such a thing as an optimal level of failure? Welcome back to our series on strategy, sustainability, and management accounting. If you have been with us for the previous sessions, you will recall that we have spent considerable time examining the first two domains of strategic action. We looked at the market, where firms compete for value and enable their positioning strategies through strategic pricing and other marketing mix decisions. And we looked at the organizational hierarchy, where structures and cultures are formed to ensure performance management, management control, and organizational resilience. Today, we are entering the third and perhaps most tangible domain, the point of production. This is the engine room. This is where labor processes turn raw materials into goods and services, and where surplus value is physically created before it is valorized in the marketplaces. This episode is dedicated to Chapter 7, Strategizing the Point of Production, Quality Costing and Management. Our journey today is structured around three critical pillars. First, we have to grapple with the definition of quality itself. It is a far more slippery concept than you might expect. Second, we will dismantle the machinery of quality costing. We need to understand how accountants measure the cost of getting things right versus the cost of getting things wrong. And finally, we will look at the clash of paradigms. We will contrast the traditional Western view, which once argued that killing a few customers could be cost-optimal, with the zero-defect philosophy that emerged from Japan and revolutionized global industry. We will wrap all of this up by returning to the Volkswagen case to see how these theories play out in the messy, high-stakes real world. Let's establish our bearings. Why are we zooming in on the point of production? In previous discussions, we established that markets are where value is realized. It's where you sell the thing, but the point of production is where that value is created. It is the complex web of techno-managerial relations, the labor processes, and the daily grind of making things. Strategizing this domain is not just about making sure the machines are running. It is about configuring labor processes to meet three distinct strategic imperatives: quality, flexibility, and cost. Today, our laser focus is on quality. In the next episode, we will tackle manufacturing flexibility. And the one after that will cover strategic cost management. But for now, we must understand that quality is the enumerating core of value for money. It is how a firm positions itself in the mind of the customer. If the point of production fails to deliver quality, the entire market strategy collapses. So, what is quality? If I asked you to define a quality pair of shoes, you might say they are durable. Someone else might say they are stylish. A manufacturer might say they adhere to the stitching specifications within a millimetre of tolerance. quality is inherently multifaceted. In the literature, we see distinct approaches. There is the product-based approach, which looks at measurable attributes like performance or durability. There is the manufacturing-based approach, which is all about conformance to specifications. Did we make it exactly as we designed it? Then you have the user-based approach, which is entirely subjective. Does it satisfy the customer's specific needs? We also have the value-based approach, which balances performance against price. Interestingly, there are even philosophical definitions. We call this the transcendental approach, rooted in the philosophy of Robert Pirsig and his famous book Zen and the Art of Motorcycle Maintenance. Here, quality is neither mind nor matter. It is an innate excellence that you recognize when you see it, even if you cannot define it. Finally, we have the social constructivist view. This suggests that quality is a story we tell ourselves, influenced by advertising and culture. When Volkswagen marketed clean diesel, they were socially constructing a quality narrative that, as we know, had no basis in engineering reality. However, for us to manage and account for quality, we need something sharper. We need an operational definition. For the purpose of quality costing, we define quality mathematically as the probability of not producing a defective product. Think of it as a formula. Quality, or Q, equals 1 minus the defective rate, or D. So, if your system has a 5% defect rate, your quality score is 95%. This allows us to treat quality as a variable, something we can plot on a graph and, crucially, something we can cost. Now that we have a measurable definition, we can break down the costs. In a quality costing system, every penny you spend on quality falls into one of two buckets: the cost of conformance or the cost of non-conformance. Let's start with the costs of being good, conformance. These are the investments you make to ensure things go right. We split these into prevention costs and appraisal costs. Prevention costs are the smartest money you can spend. This is training your staff, designing robust processes, and selecting better suppliers. It is doing the work up front to stop defects from ever happening. Appraisal costs are the costs of checking. This includes inspection, testing, and auditing. You are not preventing the defect here. You are just trying to catch it before it leaves the factory. Then we have the costs of being bad, non-conformance. This is the price you pay when things go wrong. First, there are internal failure costs. This happens when you catch a defect inside the factory. You have to scrap the material, rework the product, or retest it. It is expensive, but at least the customer didn't see it. The most dangerous category is external failure costs. This is when the defective product slips through the net and reaches the customer. This includes warranty claims, returns, and repairs, but it also includes the hidden massive costs of lawsuits, recalls, and the erosion of your brand reputation. As we saw with Volkswagen, these external failure costs can run into the billions and threaten the very survival of the firm. Here is where the history of management ideas gets fascinating. How do these costs relate to each other? For a long time, Western management was dominated by what we call the traditional quality paradigm. This was based on neoclassical economic logic, essentially cost minimization. The logic went like this: prevention and appraisal are expensive. As you try to get closer and closer to 100% quality, the cost of checking and preventing shoots up towards infinity. At the same time, as quality improves, your failure costs drop. Traditional economists argued that there is an optimal point where these two curves cross. They called it Q-opt. At this level, the total cost is minimized. The implication is chilling. It suggests that there is an optimal level of defects. It implies that it is economically irrational to be perfect. This logic led to tragedies like the Ford Pinto case in the 1970s. Ford knew the Pinto had a defective fuel tank design that could explode in rear-end collisions. They conducted a cost-benefit analysis. They calculated that fixing the car would cost $11 per vehicle. They also calculated the cost of potential burn deaths and injuries. Shockingly, they concluded it was cheaper to pay out the lawsuits for the deaths than to fix the car. This is the dark side of the traditional paradigm. It justifies ethical failure through cost minimization. But then, the world changed. Following World War II, a different philosophy emerged, primarily from Japan, driven by figures like Deming, Juran, and Taguchi. This is the zero-defect or continuous improvement paradigm. This view challenged the basic assumption. It argued that prevention costs do not rise infinitely. In fact, if you build quality into the culture, if you use total quality management, the cost of conformance actually stabilizes or decreases. You don't need an army of inspectors if every worker is responsible for quality. In this paradigm, the only optimal level of quality is zero defects. Quality is free, as the saying goes, because the savings from avoiding failures always outweigh the investment in prevention. This shift from acceptable quality levels to zero defects was a revolution. This brings us to the phenomenon known as Japanization. In the 1980s and 90s, Western companies were getting hammered by Japanese competitors like Toyota. Japanese cars were reliable, affordable, and high quality. Western cars, broadly speaking, were not. Western firms realized they had to change. They began importing Japanese management practices. This wasn't just about copying machines, it was about copying a philosophy. We saw the introduction of hard technologies, things like statistical process control and cellular manufacturing. But more importantly, we saw the struggle to implement soft technologies. These are the cultural elements, quality circles, where workers meet to solve problems, the Kanban system for just-in-time production, and a culture of Kaizen, or continuous improvement. The Toyota production system became the gold standard. It viewed waste as the enemy. Defects are waste. Inventory is waste. By eliminating waste, you increase profit. It was a complete rejection of the old trade-off mentality. You didn't have to choose between cost and quality. By pursuing quality, you achieved lower costs. So, how does a modern accountant track all of this? We can't manage what we don't measure. Chapter 7 outlines the design of a quality costing system. The most effective method is activity-based costing, or ABC. In a traditional system, quality costs might be buried in general overheads. In an ABC system, we identify specific activities. For example, handling customer complaints is an activity. Inspecting raw materials is an activity. We assign costs to these activities and then trace them back to products. This creates visibility. A manager can look at a report and see, wait a minute, we are spending a fortune on rework. Why? Effective reporting compares these costs over time. Ideally, you want to see a specific trend. You invest more in prevention. Conformance costs go up slightly, and in response, your internal and external failure costs plummet. If you see prevention costs going down and failure costs going up, you know you are heading for a crisis. Let's bring this all back to where we started. Volkswagen. The Dieselgate scandal is the ultimate case study because it shows what happens when the tools of quality are weaponized against the principles of quality. Volkswagen had a clear strategic goal: economic dominance. They wanted to beat Toyota. To do that, they needed to sell diesel cars in the US. But US emissions regulations were strict. The engineers couldn't find a legitimate technical way to meet the standards while keeping the price low and the performance high. Under the traditional paradigm, they might have said, "We can't do it," but under the pressure of an authoritarian corporate culture, a toxic soft control system, failure was not an option. So, they innovated. But they didn't innovate the engine, they innovated the deception. They installed the defeat device. Let's look at this through our quality definitions. From a product-based view, the car failed conformance. It didn't meet legal specs. From a user-based view, it deceived the customer who wanted a green car. From a social constructivist view, they successfully built a fake image of clean diesel. But look at the costs. By avoiding the prevention cost of designing a truly clean engine, they eventually incurred the largest external failure cost in corporate history. Over €30 billion in fines, settlements, and buybacks. But it goes beyond money. The external failure here included environmental damage, thousands of tons of excess nitrogen oxides, and social costs, including premature deaths associated with respiratory illness. The defeat device was essentially a fraudulent management control system. It was designed to manage political risk, the risk of getting caught, rather than managing product quality. It highlights a terrifying contradiction. You can have the most sophisticated quality costing systems in the world, but if your organizational culture prioritizes short-term economic gain over genuine sustainability, you are driving towards a cliff. As we wrap up today's discussion on strategizing the point of production through quality, let's reflect on the core lesson. Quality is not just a technical specification. It is a strategic choice. We moved from the cold logic of the traditional paradigm, which accepted defects as a cost of doing business, to the zero-defect philosophy, which views every error as a failure of process. However, as the Volkswagen case reminds us, these systems do not exist in a vacuum. They are embedded in organizational cultures. When the pressure to perform outstrips the capacity to deliver honestly, the definition of quality can be twisted into something unrecognizable. The point of production becomes a point of deception. We have now covered the first strategic imperative, quality. But in the modern, fast-paced global market, being good isn't enough. You also have to be fast and you have to be adaptable. This brings us to our next strategic imperative. In the next episode, we will turn the page to Chapter 8 to discuss manufacturing flexibility. How do firms configure their production lines, not just to be perfect but to be agile? How do they handle the chaos of fluctuating demand? Join us next time as we continue our journey into the heart of the factory floor. Thank you for listening.